The silver short squeeze was a lie, and it just cost retail investors billions. 3 weeks ago, the world was screaming, silver to $200, as we touched an all-time high of $121.67. It felt like the greatest wealth transfer in history. Fast forward to today, silver is bleeding out at $74.76. That is a 33% crash in 18 days. If you're holding the bag, you're not just waiting for a recovery, you're being liquidated by the big banks. I'm going to show you exactly who pulled the plug, why $74 is the most dangerous price on the chart, and the one move you need to make before the next opening bell. Tuesday, February 17th, New York time. Comment your date below so I can see where you're watching from. If you value this work, subscribe and comment George Williams. It really helps. Now I need you to stay with me, because what is happening in the silver market right now is not just a simple price dip. This is a full collision of global forces. Government officials making public accusations, powerful Wall Street institutions quietly flipping to sell mode, a rule change that mechanically forced thousands of traders out of their positions, and a structural supply crisis that has been quietly building underground, literally, for 6 straight years. By the end of this video, you are going to understand exactly what triggered today's move, who is really behind it, what the numbers are telling us about where silver goes from here, and, most importantly, what you should actually be watching for in the days and weeks ahead. Let's start with what happened today, because the price action alone tells a dramatic story. Silver opened the U.S. session at $77.43. Remember, U.S. markets were completely closed yesterday, Monday, for President's Day. So today is the first full American trading session of the week, and right from the open, sellers were in control. The price dropped hard through the morning, hitting an intraday low of $74.66 before finding a brief moment of stability. As of right now, we are trading at $74.76. The intraday high was $78.42, which means bulls tried to push back and failed. That high is already being treated as resistance, and that pattern, failed rallies, lower highs, is exactly what is worrying the technical traders right now. To understand just how dramatic this situation is, look at the 52-week range. Over the past year, silver traded as low as $28.16 and as high as $121.67. That is an almost 330% swing between the low and the high within a single year. Think about that. Someone who bought near the lows and sold at the top in January turned roughly $10,000 into $43,000. And someone who bought at the very top is now sitting on a loss of about 38% of their investment. That kind of range, that kind of volatility, does not happen in a healthy, stable market. It happens when something is deeply structurally broken, or deeply structurally explosive. And in silver's case right now, it might actually be both at the same time. So what actually caused this crash? Because when you see a move this violent, silver losing nearly 50% of its value from peak to trough in the initial sell-off after hitting $121, there has to be more than one thing going wrong. And there was. 3 things happened almost simultaneously, and together they turned what could have been an orderly correction into an absolute market earthquake. The first thing was a very public accusation from the top levels of the U.S. government. U.S. Treasury Secretary Scott Bessent stepped in front of cameras and directly blamed Chinese traders for what he called and I am quoting him here, a speculative blow-off. He was essentially saying that the rally that took silver to $121 was not driven by real supply and demand fundamentals, but by speculative money, hot, leveraged, fast-moving capital, pouring into the market and artificially inflating the price. Now, whether you agree with that assessment or not, and we will talk about the fundamentals in a moment, when a U.S. Treasury Secretary publicly says a market move is a blow-off, that is a signal to institutional money. It is a signal that the government is watching, that the rally has attracted official attention, and that a correction is not going to be resisted. That statement alone shifted market psychology overnight. The second factor was a rule change at the CME Group, and this one is really important to understand because most people do not know about it. The CME Group is the exchange where silver futures are traded, and they have something called a margin requirement. Think of it like this. If you want to trade silver using borrowed money, which is how most professional traders operate, the CME requires you to put up a deposit, a percentage of the total trade value, as collateral. That deposit is the margin. Before the crash, that margin requirement was 11%. The CME raised it to 15%. That might not sound like much, but here is what that change actually means in practice. If you are a trader holding $10 million worth of silver futures, you previously needed to have $1.1 million sitting as collateral. Overnight, that requirement jumped to $1.5 million. That is $400,000 in additional capital you need to produce, immediately, or you are forced to close your positions. For thousands of traders who were already heavily leveraged, this created a forced selling cascade. It was not about sentiment. It was not about the fundamentals. It was a mechanical, automatic liquidation event. Prices dropped, more margin calls hit, more people were forced to sell, which dropped prices further, which triggered even more margin calls. That is the cycle that turned a 10% correction into a 50% crash. And the third factor, the one that is actually the most fascinating and the most alarming, is something called the lease rate. Silver lease rates are what it costs to borrow physical silver in the market. In normal times, lease rates are very low, just fractions of a percent. During the January stress event, those lease rates temporarily spiked to more than 30 times their normal levels. 30 times. That is an almost unheard of number. What it tells you is that physical silver was nearly impossible to borrow. The market was so tight that anyone who needed silver to deliver on a contract or to cover a short position was paying extraordinary prices to get it. That kind of spike is a warning signal that the physical market was under severe stress, that above-ground silver is getting harder and harder to source. Now here is where the story gets genuinely interesting. Because while the short-term price action is bearish, the fundamental picture tells a very different story. And this disconnect between what the price is doing right now and what the underlying supply-demand reality looks like is the most important thing to understand if you are trying to figure out where silver goes from here. The silver market has been in a supply deficit for 6 consecutive years. Let that sink in. 6 years in a row, the world has consumed more silver than it has produced. In 2026, that deficit is projected to be 67 million ounces. Now here is the wild part. Global silver supply is actually expected to hit a 10-year high this year, reaching 1.05 billion ounces. So production is near a 10-year peak, and it still is not enough to meet demand. The total supply shortfall since 2021 has now exceeded 800 million ounces. That is 800 million ounces of silver that the world needed and could not get from mining. That silver had to come from somewhere, and it came from above-ground stockpiles, from vaults, from existing inventory. And those stockpiles are now running low. Global ETP holdings. That stands for exchange-traded products, which are things like silver ETFs that allow regular investors to own silver without physically holding it, currently stand at approximately 1.31 billion ounces. That is, the pile of silver that has been accumulated by investors around the world. And physical silver investment is forecast to rise 20% in 2026 to a 3-year high of 227 million ounces. People are not fleeing silver. In fact, individual investors are buying more of it. The sell-off you are seeing in the price right now is largely coming from the futures and derivatives markets, from leveraged traders getting forced out, not from long-term physical investors abandoning the metal. On the industrial side, silver fabrication, the silver used in manufacturing, electronics, solar panels, electric vehicles, is expected to decline 2% in 2026 to a 4-year low of around 650 million ounces. Part of this is a trend called thrifting in the solar industry, where manufacturers are finding ways to use slightly less silver per solar panel. But here's the context. Even with that 2% decline, industrial demand is still near historic highs. Silver is irreplaceable in too many technologies for demand to collapse. It is one of the best electrical conductors on Earth. It is used in every smartphone, every electric vehicle, every solar cell. The world is not suddenly going to stop needing it. And the performance numbers over the last year put everything in perspective. Silver rose 147% throughout 2025. 147%. And even after this brutal correction, silver was still up 11% in 2026 before today's sell-off. The people who were in silver early are still sitting on extraordinary returns. The crash feels terrible if you bought near the top, but zoom out, and the broader trend has been remarkably powerful. Now let's talk about what the charts are saying, because right now, the technical picture is genuinely important for figuring out the next move. I want to break this down simply so it is useful whether you are a seasoned trader or you have never read a chart in your life. The most important number you need to know is $79.42. That is the key resistance level, the price ceiling that silver bulls must break through and hold above for any recovery to be taken seriously. Right now we are at $74.76. That is more than $4.50 below that level. Until silver closes above $79.42 on a daily basis, every rally is going to be viewed by institutional traders as a selling opportunity. They call it selling into strength. The big players are waiting for prices to bounce, and then using those bounces to exit their positions or add to short trades. On the downside, support is sitting at the $75 to $75.60 zone, which we are currently testing right now. If that level breaks and price closes below it convincingly, the next major floor is at $71.23. That would represent another roughly 4.7% decline from current levels. The 5-day moving average, which tracks the average price over the last 5 trading sessions, is at $77.44. The 50-day moving average is at $79.67. Both of those are above where we are trading right now, and both are acting as resistance. When price is below its short-term and medium-term moving averages like this, it is a classic sign of a downtrend. 2 other indicators worth mentioning. The RSI, the Relative Strength Index, which is a tool that measures whether a market is overbought or oversold on a scale from 0 to 100, currently sits at 45.82. A reading below 30 would suggest oversold. A reading above 70 suggests overbought. At 45, we are in neutral territory. That tells you there is still potential room to fall before silver becomes truly technically oversold. The MACD, another momentum indicator that tells you whether buying or selling momentum is accelerating, is at negative 0.693, which is a sell signal. And when you look at all the moving average signals together, the score is 8 sell signals against just 4 buy signals. The daily technical signal for silver right now is officially strong sell. So what is the macro environment doing to all of this? Several big things are happening this week that could move silver dramatically in either direction. The U.S. January jobs report and inflation data are both coming. January CPI already came in at 2.4%, which is lower than feared and has revived hopes that the Federal Reserve will cut interest rates later this year. The Fed is widely expected to hold rates steady at its March meeting, but 2 rate cuts are now priced in for later in 2026. This matters enormously for silver. Lower interest rates make holding precious metals more attractive because the opportunity cost of owning something that pays no dividend or interest decreases when rates fall. In plain English, if your savings account is paying you 4%, you might not want to hold silver. If it drops to 2%, silver suddenly looks a lot more appealing. There is also the Kevin Warsh situation to watch. He is being considered for a major Federal Reserve position, and his Senate confirmation could shift expectations around how hawkish, meaning how aggressive about keeping rates high, the Fed will be. A more hawkish Fed means a stronger dollar, and a stronger dollar is historically bad for precious metals. It is one more variable in an already complex equation. And one more thing to keep in mind. The Chinese Lunar New Year runs from February 16th through the 23rd. During this period, Asian markets are running with much thinner liquidity. Fewer participants, smaller volumes. That thin market environment can amplify volatility in both directions. A relatively small order can move prices more than it normally would. So expect the unexpected in terms of intraday swings this week. Now for the forward-looking scenarios. And I want to be very clear that this is not financial advice. This is analysis of what the data and the setup suggest. There are 2 realistic paths from here. In the bullish scenario, silver needs to hold the $75 support level, stabilize, and then on the back of positive macro news, a weak jobs report, soft Fed commentary, or dollar weakness, push back above $79.42. If it can close above that level convincingly, the narrative shifts from breakdown to recovery, and we could see a move toward the $82 to $92 range over the following weeks. The structural deficit story, the physical investment demand surge, and the rate cut tailwind would all reinforce that move. Bank of America's analyst Michael Widmer has a target range of $135 to $309 for silver in 2026. Citi is at $150. Gold Silver's Alan Hibbard is calling for $175 and above. These are not fringe predictions. They come from major institutions with serious research behind them. They are based on the deficit math, the rate cut thesis, and growing investment demand. In the bearish scenario, and this is the one the technicals are currently pointing toward, the $75 support breaks. Maybe the jobs report comes in stronger than expected, keeping the Fed on hold longer than the market hopes. Maybe the dollar strengthens on the back of the Warsh confirmation. Maybe another wave of margin calls or profit-taking in Asia hits during the thin Lunar New Year liquidity window. In that case, we could see a test of $71.23, and potentially a longer consolidation phase before silver finds a durable bottom. The leveraged money has not fully cleared the system yet. That is the real risk. When there are still traders who borrowed heavily to be long silver and are sitting on losses, every bounce can become a selling event as they try to exit into any strength. So where does that leave us? Right now, the honest answer is this. The short-term technical picture is bearish, the immediate market environment is uncertain, but the long-term fundamental case for silver has not broken. 6 years of supply deficits do not fix themselves overnight. 800 million ounces of above-ground inventory do not magically reappear. Rate cuts, when they come, will be a tailwind. Physical demand from long-term investors is rising, not falling. The price is in a painful correction, but the story is not over, not by a long shot. The key things to watch this week are the jobs data, the inflation print, any Fed commentary, dollar movement, and whether silver can hold that $75 support level. If you are in silver for the long term, those fundamentals are still intact. If you are a short-term trader, the technicals say this is not the moment to fight the tape. Respect the trend until the data gives you a reason to change your view. I want to hear from you. Drop a comment below right now. Are you bullish or bearish on silver from here? Did you buy the dip, or are you waiting for a lower entry? And remember, comment your date and location so I can see where this community is watching from around the world. That always blows my mind. If this breakdown helped you make sense of a confusing day in the market, hit that subscribe button. It takes 2 seconds, and it keeps this kind of deep dive content coming. Share this video with someone who is trying to figure out what is happening with silver right now. Let's get them the information they need. I will see you in the next one. Stay sharp, stay informed, and keep watching the $79.42 level. That is your signal.